In just 47 days, 37.6 million ounces of silver vanished from COMEX vaults, the largest drawdown since 1980. Then, late Saturday, something unsettling became clear. Four major South Korean banks had quietly suspended silver sales, not during market hours, but while markets were closed. On Friday, silver was aggressively pushed towards $65. It didn't break. By the time traders processed what the Saturday silence really meant, silver had already moved past $67.30. If silver isn't strategic, why did banks step back when no one was watching? And if $65 was the last line of defense, what happens on Monday? To understand why the events of that weekend mattered, it helps to step back and look at what silver actually represents and how the modern commodity system was built. For most of history, silver was money. It backed currencies, settled trade, and anchored trust. In the United States, silver coins circulated until 1965, when rising industrial demand made the metal too valuable to remain in everyday currency. From that point on, silver was quietly pushed out of the monetary system and replaced with paper promises. Those promises evolved into today's commodity markets. Futures contracts were designed as hedging tools, a way for miners and manufacturers to lock in prices. Over time, however, these contracts became financial instruments, traded in volumes far exceeding the physical metal available. On exchanges like COMEX, hundreds of paper claims can now exist for every ounce of silver in a vault. This imbalance is usually invisible, but it becomes obvious during periods of stress, especially when a market enters backwardation, a rare condition where the price of silver for immediate delivery rises above future prices. Backwardation signals one thing: people want metal now, not later. We have seen this before. In 1980, the Hunt brothers attempted to corner the silver market, triggering a price spike and a swift regulatory response that rewrote the rules overnight. Prices collapsed, and the lesson seemed clear: the system would always intervene to protect itself. What makes today different is not speculation, it's necessity. Silver is no longer just a store of value. It is a critical industrial input, embedded in solar panels, electric vehicles, advanced electronics, and military systems. A shortage today doesn't just move prices, it threatens supply chains, technology timelines, and national priorities. And that is why the quiet signals from that Saturday mattered. At the heart of the silver shock lies a problem that cannot be solved with policy statements or emergency meetings. Physical supply is no longer keeping pace with reality. In 2024, global industrial demand for silver reached 680.5 million ounces, driven largely by renewable energy, electrification, and advanced manufacturing. At the same time, total supply fell short, leaving a deficit of 148.9 million ounces in a single year. This was not a one-off imbalance. It was the continuation of a structural trend that has been building quietly for over a decade. Unlike gold, silver is rarely mined on its own. Roughly 70% of global silver production is a byproduct of copper, zinc, and lead mining. That means silver output cannot simply be increased because prices rise. If copper demand slows, silver production slows with it, regardless of how urgently the metal is needed elsewhere. This creates a dangerous rigidity. Demand can surge almost overnight, but supply responds slowly, if at all. Mines take years to develop, capital investment remains constrained, and environmental regulations further limit expansion. The result is a market where shortages don't announce themselves loudly. They appear first in inventories, then in delivery delays, and finally in price behavior that no longer obeys old rules. And once that process begins, it becomes extremely difficult to reverse. If constrained supply is the foundation of the crisis, industrial demand is the accelerant. Silver is no longer consumed primarily by investors or jewelers. Today, it sits at the core of modern infrastructure. Each solar panel requires silver paste for conductivity. Electric vehicles use significantly more silver than combustion engines. 5G networks, data centers, and advanced AI hardware all rely on silver's unmatched electrical and thermal properties. There is no easy substitute at scale. This demand is not cyclical. It is policy-driven. Governments around the world have committed trillions of dollars to energy transitions and digital expansion. Those commitments translate directly into long-term silver consumption, regardless of price. The stress surfaced first in Asia. Shanghai's silver inventories fell by 86%, a collapse that forced an extraordinary response. 660 metric tons of silver were rushed to London, not for speculation, but to keep industrial supply chains functioning as London vaults themselves approached depletion. This movement of metal tells a critical story. Silver was no longer flowing toward profit. It was flowing toward necessity. When physical metal begins moving across continents under urgency, it signals that contracts and promises are no longer sufficient. At that point, silver stops behaving like a commodity and starts behaving like a strategic asset. While physical silver was being quietly drained from vaults, another market continued to expand in the opposite direction: the paper silver market. On exchanges like COMEX, silver is traded primarily through futures contracts. In theory, these contracts represent future delivery of metal. In practice, they function as financial instruments. At times, between 100 and 400 paper contracts exist for every single ounce of physical silver registered for delivery. Most traders never intend to take possession. Positions are rolled forward, settled in cash, and absorbed by the system. This structure works until it doesn't. History offers a clear precedent. In 1980, as silver prices surged during the Hunt Brothers episode, regulators introduced Silver Rule 7, sharply raising margin requirements and changing the rules mid-game. Prices collapsed. The message was unmistakable. When physical stress threatens the system, the rules can change overnight. Today, the same vulnerabilities are resurfacing, but with a geopolitical twist. China has restricted retail access to precious metals. South Korean banks have halted sales. Russia has increased holdings of non-dollar assets. These are not speculative moves. They are defensive ones. And when nations start preparing quietly, it raises an uncomfortable question. Is the paper market still setting the price, or merely delaying the reckoning? The silver market's imbalance is not an isolated case. History shows that when a material becomes strategically essential, control over its supply quickly becomes a geopolitical tool. A clear parallel can be found in rare earth elements. China currently controls roughly 70% of global rare earth mining and over 90% of refining capacity. This dominance has allowed Beijing to influence prices, restrict exports, and shape entire supply chains. Industries and governments that once relied on open markets found themselves scrambling for alternatives, often too late. Silver exhibits a similar vulnerability, but without a single visible gatekeeper. Instead, the imbalance is hidden within financial structures. The gold to silver ratio, now hovering around 79 to 1, sits well above its historical average of roughly 69 to 1. This suggests that silver remains systematically undervalued relative to gold, not because it is less useful, but because its price is still anchored to paper mechanisms. The consequences extend far beyond trading desks. Green energy projects face rising input costs. Electronics and defense manufacturers confront supply uncertainty. If even 10% of paper silver holders demanded physical delivery, exchanges like COMEX would struggle to meet obligations. A scenario that could trigger forced cash settlements and erode confidence across commodity markets. The burden would not be shared equally. Nations and institutions with physical reserves would gain leverage. Those dependent on imports would absorb higher costs, slower growth, and strategic vulnerability. In that environment, silver ceases to be a market and becomes a dividing line. Once a market reaches this stage, the question is no longer whether intervention will occur, but who will act first and at what cost. For governments, the most urgent step is transparency. Strategic metals cannot be managed effectively if reserves remain opaque. Several countries are already moving to localize supply chains, incentivize domestic refining, and expand recycling programs to recover silver from electronics and industrial waste. These measures are slow, but they are no longer optional. For industry, adaptation is unavoidable. Manufacturers are experimenting with silver thrifting technologies and alternative materials, but progress remains limited. Silver's conductivity and reliability are difficult to replace without sacrificing performance, especially in defense and energy systems. Investors face a different decision. In periods of structural stress, paper claims offer convenience, not security. Physical ownership removes counterparty risk, but introduces constraints of storage and liquidity. Each choice carries trade-offs, and none are without risk. Looking ahead, forecasts diverge sharply. Bank of America projects silver between $75 and $100 by 2026 under a stable market scenario. A disorderly unwind of paper markets could push prices toward $120 to $170. Conversely, a coordinated release of state reserves, particularly from China, could temporarily suppress prices. The future is not predetermined, but the range of outcomes has widened, and that alone changes behavior. The pattern unfolding in the silver market is not new. It follows a familiar four-stage cycle: establishment, suppression, constraint, and fracture. For years, silver was established as a financial asset, then suppressed through paper markets. Today, it has entered the third phase, physical constraint, where availability, not sentiment, dictates outcomes. The numbers tell the story: a cumulative deficit approaching 820 million ounces, vault withdrawals at a pace unseen in decades, banks stepping back quietly, not loudly. These are not the signals of a market in balance, they are warnings. History suggests that when systems reach this point, adjustments come swiftly, often without notice and rarely without consequences. The question is not whether silver will matter, it is who will be prepared when it does. Are you holding physical silver, paper exposure, or standing on the sidelines? Whatever your position, the next phase is unlikely to unfold in silence. If you want to follow how this story develops and what it may mean for markets, policy, and everyday life, consider subscribing for the analysis ahead.